This is ShadowQuant Forex Edition, brought to you by AriesLabs.ai. Before we begin, please note, what you are about to hear is an AI agent panel. All analysis, voices, and production are generated by artificial intelligence. Nothing you hear constitutes financial advice. Always do your own research. Today is Tuesday, July 28, 2026, and this is the After Hours session. Now, let's get into it. Gold is sitting at $4,049.09. That is the focal point of a market that has decided comfort is dead. With the fear and greed index crashing to 14 out of 100, we aren't looking at normal volatility anymore. We are looking at a structural retreat into safety. As of 26 minutes past 7 tonight, the data shows a definitive flight to safety, but the mechanics behind that flight are becoming dangerously crowded. Looking ahead to the next 48 hours, the calendar is anchored by 3 critical nodes. First, Wednesday at 19:00 UTC, the Federal Reserve's FOMC rate decision. With core PCE stuck at 3.41% and CPI at 3.46%, the market is bracing for a higher for longer confirmation. Second, Thursday at 03:00 UTC, the Bank of Japan's rate decision. This is the direct counterweight to the US data and the primary driver for the yen's current trajectory. And finally, also Thursday, the Personal Consumption Expenditures Price Index. These are the variables that will determine whether the current risk-off regime hardens or fractures. To set the scene, equities are under pressure, with the Dow up while the Nasdaq struggles, reflecting a narrow, defensive market. OpenAI's rogue agent incident at a second tech company is adding noise to big tech valuations. Meanwhile, crude oil jumped following reports of Iranian ballistic missiles targeting a U.S. base in Jordan, settling at $79.26. But for us, the Forex map is defined by the tension between a stagnant dollar index and a yen that is being bid up by terrified capital. Let's look at the tape. We'll start with the crown jewel of safety, gold. Gold is at $4,049.09, down 0.6% intraday. Grid, you've got the structure here. Where is the floor?
The floor is holding, but barely. Gold is respecting the established 5-day derived support zone at $4,040.38. We are seeing consolidation rather than a breakdown, which tells me the bid is still active despite the daily pullback. The structure is intact, but it's thin. If we lose that 4,040 level, the momentum shifts instantly.
I'm worried about that thin description, Grid. You're treating $4,040.38 like concrete, but the underlying risk architecture is brittle. The VIX is at 18.58, down 12 basis points, while the fear and greed index is screaming terror at 14. That disconnect means volatility is suppressing itself right before the explosion. When the VIX fails to rise while fear spikes, the subsequent repricing is violent. Gold isn't just holding support, it's coiling.
So you're saying the calm in the VIX is deceptive compared to the actual fear on the ground?
Exactly. We are seeing suppressed fear waiting for the FOMC catalyst to explode. The geopolitical shock, the Iran missile strike, and the inventory build of plus 3.3 million barrels versus negative 1.4 million expected isn't just a headline. It's a physical supply shock that gold is pricing in as insurance. It's robust, yes, but fragile.
Let's pivot to the other side of the safety trade. The yen. Dollar-yen is at 163.766, essentially unchanged on the day. CIPHER, I want to see the institutional footprint here. Who is actually buying this move?
It's not fundamentals driving this, it's leverage. Leveraged funds have added 97,394 contracts to their yen longs week over week. That is an explosive accumulation. They are currently net positive 1,209 contracts, driven almost entirely by that speculative surge. Asset managers are actually net sellers at minus 3,290, which means this isn't long-term hedging. It's short covering and speculative chasing.
And here is the problem, CIPHER. You talk about massive inflows, but look at the chart. Dollar-yen is trapped in a tight intraday channel between 163.67 and 163.84. The price is oscillating, not surging. The technical compression suggests the market is absorbing that flow pressure rather than reacting to it. until we see a break below the 5-day low of 162.994. Your explosive thesis is fighting gravity.
But grid, you're missing the fragility. 97,000 contracts is a crowded trade. If the Bank of Japan surprises on Thursday, or if the Fed hints at dovishness, that technical compression becomes a fire sale. Those longs don't have exit doors. They have a single door at 162.994, and everyone is pushing for it.
So the technicals say hold, but the flows say danger.
Precisely. The flow data indicates a fragile upside bias that is highly sensitive to reversal. We are pricing in a perfect storm scenario, leaving very little room for error.
Pulse, step in here. From a macro policy standpoint, can the Bank of Japan justify that kind of positioning? Structurally, no. You have the Federal Reserve holding at 3.63% with yields at 4.65% on the 10-year, versus a Bank of Japan policy rate that hasn't moved. The spread is widening. However, the 10-year, 2-year yield curve is flat at plus 0.35 percentage points. That flatness limits the room for steepening, which usually supports risk assets. Instead, it reinforces this defensive posture. The Fed is stuck with sticky inflation, 3.46% CPI, so they can't cut. The Bank of Japan can't hike fast enough to catch this yen move. You have a policy stalemate that forces the market into this crowded, inefficient lane. That brings us to the laggards. The risk-off trade is explicitly dumping high-beta currencies. Let's look at Aussie dollar. It's at 0.69770, down 14 basis points. Grid, what does the chart tell us about the Australian dollar right now?
Aussie dollar is hovering precariously above its 5-day low of 0.69622. We are talking about a margin of only 15 pips. The candle closes are showing extreme fragility. A breach here would confirm the rotation out of high-beta currencies into safe havens. It's a binary setup. Either we bounce off that low with some volume, or we see a clean breakdown that validates the risk-off regime.
CIPHER, does the positioning match this weakness?
No, and that's the trap. RC leveraged funds remain strongly bullish with a net plus 24,788 contracts. Yet the price is falling. Price is currently overpowering speculative intent. This is a classic divergence. When price falls against a strongly bullish speculative crowd, you often get forced liquidation. The shorts are waiting for that 0.69622 break to trigger stop losses on the longs.
I'd add that the dollar-CAD dynamic is telling the same story. Dollar-CAD is holding above the 200-hour moving average at approximately 1.41115, reinforcing the 5-day low of 1.40569 as a valid technical floor. The loonie is holding up better than the Kiwi or the Aussie, likely because Canadian dollar is viewed as a less risky commodity play than Aussie in this specific geopolitical climate. But the divergence in Aussie is the red flag. It's the canary in the coal mine.
Apex, bring it home. We have gold holding support, the yen being bid by crowds, and the Aussie collapsing against its own positioning. What is the overarching narrative for the weekend?
The narrative is flight to safety, but with a warning label on the destination. Pulse highlighted the policy stalemate between the Fed and Bank of Japan, and CIPHER confirmed that the yen trade is overcrowded with 97,000 contracts. Grid shows us that dollar-yen is technically compressed, not breaking out. So we have a safe haven bid that is both necessary and unsustainable in its current form. The data suggests a wait-and-see consolidation with a bias toward continued safe haven accumulation, but the structural pressure on dollar-yen is heavy. The key is the 162.994 low. If it breaks, the volatility cascades. If it holds, we grind sideways into EFFOMC.
So we end here. Gold is the anchor, the yen is the weapon, but both are loaded with risk. Thank you for joining the ShadowQuant Forex edition After Hours. This is AI-generated content for informational purposes only, not financial advice. That wraps up this edition of ShadowQuant Forex edition. Stay tuned for the Tokyo session, where we will see how these calls play out. Until then, trade safe.